Let's talk about a DSCR mortgage here in Hawaii. It's not about how much money you make, it's about how much money the property generates. It's a real clean solution, and let me explain to you how it works. All right, let's start off by talking about the down payment reality side of a DSCR mortgage. A lot of the times people see 20%, 15%, and they think that's the starting point. Well, the truth is that it comes down to probably three different factors. The first thing is the borrower's credit profile. Is their credit score really, really strong, or is it not? The second thing is the actual lender you're working with. Every lender has different overlays and different requirements. That's why working with a broker is absolutely paramount, because that way it opens up, it expands your opportunities for the different lenders that they can work with. And then finally, the property type. What are all the factors of the property that come into consideration? Those will impact the down payment requirements. So 20% is really just a starting point, but the reality is it could be different. All right, let's talk about the DSCR ratio, debt service coverage ratio. And this is what everybody thinks about when they think of this mortgage type. What is it and how is it calculated? On one side of the equation, you have your monthly expenses, principal, interest, taxes, insurance, and homeowners association fees. Those are all on one side of the equation. The other side of the equation is the property's income. And that income is based off an appraisal that's done. So, what is the income? To factor in what the ratio is, you take the income, you divide it by the expenses, and that gives you a ratio. Really, the benchmark is 1. If anything is 1 or higher, then that's a good ratio. If it's below 1, then that's when lenders really start getting involved and saying, this is more risky, and they either won't do it, or if they do it, then they offset that risk by requiring a higher interest rate. So that's the debt service coverage ratio. So it's absolutely important to talk about what sets the product and the lender apart. So what I really mean there is that these really don't work well unless you work with somebody who's very familiar with them. How do these products work? What do the lenders look for? And what are the key ingredients? For instance, if a client comes in and says, I have this property, I would love to get a DSCR mortgage on it. The first thing I would do is I would investigate what are the ballpark rents for that particular property. That's important because you right away have to put it into different buckets. Okay, so then what happens? Well, part of the evaluation is an appraisal needs to happen. Not just an appraisal on the property to understand the value, but an appraisal to understand what the rents will be for that property, whether it be monthly or whether it be nightly for a short-term rental. That appraisal will come back and the lender will then evaluate that. And sometimes they may even put another factor on top of that. But what does that mean? It means what income do the appraisers believe that the property will generate? That goes into the ratio. So that's absolutely important because that sets the basis for the ratio itself. Okay, what are the other things to consider? Well, typically here in Hawaii, a lot of DSCR investor properties are condos. They're part of a condo association. What does that mean? And why is that tricky? Well, it's tricky because every condo is different. What are the factors of that condo? And these are the things that a lender, especially a lender who understands how to lend in this space, will be asking questions about. What is the timeshare contingent or capacity of that property? How many primary residences versus investors are in that complex? And what are the other factors of the HOA? Are there many people behind in paying their HOA fees? Is there any litigation against the property? These and other things are the factors that a lender will need to consider. So it's important to work with somebody who's familiar in the space and knows how to work with a lender who can navigate these intricacies and these complexities, because you don't want to get halfway through a process and pay for an appraisal and find out that that lender you're using just can't do it. It happens. So working with somebody who's familiar in the space is absolutely critical. Let's talk about some of the other intricacies of transactions like these. What if the appraisal comes back and the rent is far lower than what was calculated or what was hoped for? Well, that happens, and it's important to have contingencies in place. One contingency could be a higher down payment. Sometimes lenders have these levels and they'll say, if we put down more money, it will bring the factor up, the ratio up. That's a good solution. Another solution might be tiers of ratio levels. Some lenders may have an above 1.0 level and then also a below, maybe a 0.9 to 0.1, or maybe even a no ratio situation. So it's important to know who offers what in this space. Another complexity to consider is, what if the HOA is non-responsive, or what if there's some litigation going on? Having the know-how how to navigate and build relationships with the HOAs to get the answers is absolutely important. Not wasting any time when answers aren't coming in is absolutely critical. And also working with a lender who's familiar with litigation aspects. Litigation is actually common. It's one of the vehicles that homeowner associations have to hold the builder accountable to make sure that everything's done properly. One factor that is rarely discussed and is absolutely important is prepayment penalties. These are almost always a part of a DSCR mortgage, and there's different levels. There could be a 1 year, 2 year, all the way up to 5 years. What does prepayment penalty mean? It essentially means there's a penalty baked in if the borrower was to refinance or sell the property within that certain period. So if it's a 1 year prepay, if it's refinanced or sold within 1 year, then the borrower would have to pay a penalty. It's just the lender's way of saying, I am lending money. I want to ensure that I'm going to be getting something back for my investment. And the borrower then can make a decision. Do I want a better interest rate by picking a higher prepayment penalty or a lower prepayment penalty? It's all part of the decision factor. So having somebody who can best explain that and show the different options is very important. So as you can see, there's a lot of moving parts with DSCR mortgages. The takeaway that I would love to impart with people is, there's a lot of lenders who offer these, but there's not many who are expert at closing them in Hawaii. Work with a lender who can get the job done. It's nothing worse than getting halfway through a transaction with a lender who promises the best rates, but then they find out they just can't get it done. If you have any questions, if you have a property in mind, reach out. I absolutely love talking these products, and I love these properties in Hawaii. So hopefully we'll talk sometime. Until then, aloha.